Hi guys, welcome back. So in this video we'll be discussing about the credit spreads in options. That means collecting premium with defined risk. So today we'll be talking about what is spread, maximum risk, maximum rewards with some examples and what is the right conditions in the market to buy and sell something kind of like this executing this kind of a strategy, right? So as per me this strategy is very much useful for those who are looking for a monthly income, like it's very steady and stable income to some trader who want to run their monthly expenses out of it. So let's start with that. So what is a credit spread? Credit spread is something like you need to sell and buy the underlying future contract but with different strike prices, right? With this you'll be selling a higher premium option strip and need to buy a low premium option strip. So on this way, you'll be get collecting premiums, and you're also defining your risk, like you are mitigating your risk by buying the low premium option strip. So with this way, your risk is defined and your profits are also defined. They are like you're capping your profit and you're capping your risk also. So that's about what is spread. Then what is the maximum risk, maximum reward? So both the topic I'll be covering with a sample example. So before that, let's go to what is the right market condition to execute this kind of strategy. As per me, uh, whenever you are speculating that the market is already, taken the move, like let's say the market has taken a bullish move or taken a bearish move, and now it is hovering around some kind of a label like resistance level or support label. So on that way, on that particular point you can execute the strategy so that it will give you a maximum profit out of it, like and there will be no risk at all. So this is a very safe strategy. So let's start with that. So today the Nifty is now hovering around uh yeah, where's my chart? What is the current price of Nifty? So this is Zero the Pi application, and you can see Nifty is around 8170. So and yeah, and you can see at the Bollinger Band, uh, the high Bollinger Band is at 8400 plus, and the low Bollinger Band is around 7800. So you will be executing the strategy, and my views on the market is bullish. So I'll be taking that consideration that market will go up, and it will not come down. If it is coming down, then there is a resistance, like there is a support at around 8000 and 7800. So keeping these things in my mind, I'll be getting the strategy. So let's come back to our Excel. Yeah. So for this strategy, we need to sell a option contract with a high premium price. So as we have already discussed, like what is the support level for Nifty now? It is around 8000. So let's sell a high premium 8000 put option at around 50 rupees, and let's buy a 7900 put option at around 30 rupees, right? So on that way, you will see the premium that you are collecting is around 50, and the premium that you have to give around 30 rupees, right? So on that way you will be getting a premium of 20 rupees, and that is the maximum profit you will be getting out of this strategy, right? And so this is the maximum reward, that is 20 if you are doing away with 8000 and 7900. And what is the maximum risk? So for maximum risk, you can see if the market will not favor you and against you, the market will fall down drastically and it will go down to in between 8,000 to 7,900. So on that way, or let's say at the expiry date is touching out 7,900. So both, so the 7,900 put contract will be zero and 7,800 put contract will be around 100 rupees. So on that way, the maximum risk is you are getting 100 rupees as a loss, and you have collected a premium of 20. So the maximum risk will be 100 minus 20. So it's 8 rupees, right? So maximum risk is 80, and this is going against, like market is not obeying you, that whatever you have predicted, it's going against you. On that way, it will be the loss condition, and the maximum loss will be 8 rupees. You can also reduce the losses, like doing away with 7,950 put and the 7,900 put. So on that way, if you have to sell the sell the 7,950 put and buying a 7,900 put, on that way the profits will also limited, like it's 10 rupees, now it's half, and the losses are also 50% reduced, like half. So you can always play with the numbers. You can crunch the numbers, and you can get some better figures out of it. So according to me, I can execute this trade for this month, and within a week only, I'll be getting around 20 points as rewards. And as I don't think the market will fall down, so that way I'll be getting a monthly income. So and this strategy, guys, is very much helpful for those guys who want a low risk and stable income out of the market. So if you have let's say 4 to 5 lakhs of rupees in your account, on that way you'll be getting around 40 no, monthly around 20,000, you may say, out of it. And that way, when your portfolio goes up, you can generate more income, and it will you can definitely replace your salary out of it. And if you are doing this strategy for 12 months, out of this, let's say 2 months, the volatility in the market is more, so you may face some losses. But out of the 12, the 10 months, you will be getting surely this profits, and that profit will always know on a positive side. And guys, trust me, if you really wanted to replace your salary or replace your monthly runs out of it, you can do that. So this is all about it. And if you like this video, please like and share with your friends. And please, if you have not subscribed my channel, please subscribe, so that in the future, if I'll be posting some more videos, you will be getting it. So thank you, guys.